Hello folks, Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of 3 different market timing reports for advanced options traders on the SPX. This will be for Friday, July 27th, getting ready for Monday, July 30th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All 3 reports rely on the current market condition, and we look at the current market condition in terms of 3 different dimensions: price action, trend, and the stochastics. In terms of price action, Friday was a downswing bar of a large magnitude following an inside bar on Thursday. This is occurring when we have an uptrend. We're definitely above the 50-day simple moving average. And in terms of the stochastics, it is trending downward between 60 and 100. All 3 dimensions create a market condition that has occurred only about 62 times since January of the year 2000. Pretty amazing, isn't it? And that's because of that inside bar. Inside bars just simply are not plentiful out there. And so that's the reason for us having less than 100 incidences of this exact market condition. Nevertheless, we're going to take this and move forward and look at the first report. This is for those that trade condors and butterflies and similar type of market neutral strategies. Since July 2000, we've had roughly 4,674 daily closes of the S&P 500, and of those, 65.1% have been favorable bars for selling options premium, where the actual 21 bar subsequent movement was less than what was being implied by the skew adjusted VIX. The implied movement from the skew adjusted VIX. Once again, almost 2/3 of all the bars in the S&P 500 since Jan of 2000 have been favorable for doing condors and butters for starting a campaign because the subsequent movement was less than what the options prices were implying. Okay, so that's our benchmark, roughly 2/3, 65.1. Now, also during that time, our current condition, as I expressed, has occurred 62 times. Now, of those 62, roughly 70%, 69.3% of the bars have been similarly favorable. This means we have a premium selling edge of roughly 4.3%. Okay, so statistically, it's more likely than normal that our current market condition will end up being a favorable one for market neutral option premium selling using strategies like condors and butters. Okay, and by the way, I use Metastock in all of my research work along these regards, and we have a couple hundred interweaving custom created formulas within Metastock to create this information that's before you here today. Now let's go to the bull put spread report. This is for those that like to sell put premium out of the money in the S&P 500s. Roughly, and the scenario is a standard deviation away, 30 days out. Since Jan of 2000, we've had, as I expressed, 4,674 daily closes of the S&Ps. Of these, 83% have been favorable for selling put premium, standard deviation out of the money, 30 days out, where the actual 21 bar downside movement was less than what was being implied by the SIBO's skew adjusted VIX implied movement. Okay, so we have the VIX, and we create and we understand that there's an implied downside movement that's higher than the implied upside movement because of the vertical skew. The SIBO publishes a skew number that we use to extract that downside move. Okie dokie. And so that implied downside move in this report, FYI, is located right up here. It's at 16%. You see that? Okay. And the strike 30 days out, a standard deviation away, is at 26.92. I just want to point that out. Now let's keep going. We've had 62 occurrences of our market condition here. Of those 62, instead of 83%, of those 62, 83.8% of the bars were favorable for put premium selling. So that's pretty much a wash. We're only about 0.8% higher. So it's technically a little bit more. Statistically, technically, it's more likely than usual that the current market condition will end up being a favorable one for selling that out of the money put premium. Okay, kind of a wash, but that's kind of the way. So basically, roughly 17% of the time, the market's going to move down and touch your short strike. Okay, 83% of the time it's not. And so does that guarantee you're going to make money? No, but just run the statistics, and you want to trade when the odds are in your favor. So there you go. Let's go to the next report, and that's the S&P 500 Market Likelihood Report. What we do here is we take a 5-day rate of change over the course of the 4,678, in this case, 4,678 closes of the S&P 500. We take a close, we look 5 bars later and see how much the market moved. And you can go through all 4,678 occurrences, and the average 5-day rate of change is at positive 0.1%, a tenth of a percent to the upside. And that's because since Jan of 2000, the market's risen, right? The average 5-day rate of change is at 0.1. The average 2-week or 10-day rate of change, 0.19. The 3-day rate of change is at 0.29. Almost a little, more than a quarter of a percent to the upside over the course of 3 weeks. That's the average. That's the benchmark. Okay. Now, over here I list the standard deviations, and we'll get to the realized volatility in just a little bit. Now, we take the 62 occurrences of our market condition, and of those 62, okay, the average 5-day rate of change, when you look at all 62 of those, average up the 5-day rates of change and divide by 62, the average 5-day rate of change is at positive 0.31. Almost a third of a percent to the upside instead of just 0.1. Now, how significant is that? Okay, we have what's called a z-score, and a z-score takes that difference, 0.31 minus 0.1, difference of 0.21. We divide by the standard deviation of 0.81, and we get right here a z-score, which is the percentage of a standard deviation, in this case to the upside, that difference is. So of those 62 occurrences, yeah, the average 5-day rate of change is 0.21 difference to the upside. That reflects roughly a quarter of a standard deviation difference to the upside. Okay, if we were at 1 standard deviation, we would really take notice. When you were at only a quarter of a standard deviation, is that significant? Well, not that much. Okay, not near as much as a half or a full standard deviation to the upside. Then we go to the 10 and the 15-day rates of change, which are indeed higher than the baseline, but those z-scores are again not even a quarter of a percent, a quarter of a standard deviation to the upside there. All right, now we divide those 62 up into those times when the market rises above the high from Friday and those where it goes below the low of Friday. Okay, 25 times it went above Friday's high, and when it did that, well, you can imagine then that the 5-day rate of change was pretty much fatter to the upside, although it is in the short run, not in the long run. Look at that, and the z-scores are again, flat pretty well, underneath a quarter of a standard deviation to the upside. In the short term, though, look at that, a full standard deviation on the short-term 5-day rate of change. So if it does go above, if on Monday it goes above Friday's high, look for there's a much greater likelihood for a short-term pop to the upside than looking 2 and 3 weeks out in the future. Okay, now, of those 62 times, 27 times it descended below Friday's low, and in those situations, the z-score was at 0.59, again on the short, looking at in the short run, 0.5, almost 60% of a standard deviation to the downside, and the other two are flat. So again, a short-term likelihood in that direction rather than looking 2 and 3 weeks out. In terms of volatility, the benchmark volatility of the market is roughly 15 to 16%. Of our 62 occurrences of this market condition, the realized volatility turned out to be much, much lower, 12 to 13%. The VIX is at 13%, okay, a little bit higher than those in the short run, okay. So, and that kind of lends itself to having a little bit reflecting the edge historically for selling premium that this market condition has obtained. It's kind of showing itself to be consistent here. Okay, and of course we divide it out in terms of the upside move, what the realized vol was for those 25 on average, and then on the downside as well. Okay, the 9-day VIX is underneath the 30-day VIX, so that's more of that's an indication for more of a green light to sell premium as opposed to it being inverted. Okay, folks, that is it for me in these reports. I hope you find these reports informative and helpful in your trading. Take care. Have a great rest of the day. Bye.